What's up, YouTube? It's your boy Ty, and I'm back in here with another episode of How To Options. Today, we're going to be going over straddles and strangles, specifically the short straddle, the long straddle, the short strangle, and the long strangle. Alright guys, let's do it. Please hit the like button and please subscribe, and catch me every weekday after market close on the Smarter Gambling Show. Alright, let's start with the short straddle. A short straddle is when you sell a call and a put with the same strike and expiration date. You will receive a net credit for this trade. One side will always finish in the money and one side will always finish out of the money. This is a neutral strategy, and you will get the best results when the stock trades flat or sideways. This strategy is good for taking advantage of high implied volatility, just like every other strategy that involves receiving a net credit. The net premium collected equals max gain. This is achieved when the underlying price equals the strike price. The max loss is unlimited, and this occurs when the underlying goes deeper in the money. The short call strike plus the premium collected equals the upper break even. The short put strike minus the premium collected equals the lower break even. Alright, now let's take a look at an example on a graph. So for this example, I'm going to be using GME at the January 21st, 2022 expiration date. Here, I sold a call at the 250 strike for $6,800, and then I also sold a put at the same strike, 250, for $10,200. So here's the graph. We can see that it looks like a triangle. So our max gain would be when the underlying is at $250, which is the strike price of this short straddle. Our max gain is our premiums collected, so that is $17,000. $6,800 plus $10,200 equals $17,000. Our max loss is unlimited, and this occurs as the underlying moves further away from the strike price of $250 in either direction. We can see that if we go to the downside, we keep losing money. And then if we go to the upside, we keep losing money. We can see here that our lower break even is when the underlying is at $80. And to get that, we take our strike price, $250, minus our net premium collected, which is $170 or $17,000, and we get 80. And we can see on the other side, our upper break even would be when the underlying is at $420. And the way we get this is we take our strike price, $250, plus our net premium collected, which is again $170 or $17,000, and we get $420. Now let's move on to the long straddle, which is essentially just the inverse of the short straddle. This is a neutral strategy, and you are looking for a big move in either direction. You will receive a net debit for this trade. To set this trade up, you buy a call and you buy a put with the same strike and expiration date. One side will always finish in the money, and one side will always finish out of the money. Theta negatively impacts this strategy, meaning time is not on your side. You want serious price action on the underlying, and you want it fast. This strategy is good in low implied volatility environments, hoping it becomes high. Do not use the strategy in already high implied volatility environments. The max gain is unlimited. Your gains will grow as the long call or the long put moves deeper in the money. The net premium paid equals max loss. This occurs if the contracts expire at the money, worthless. The long call strike plus premium paid equals the upper break even. The long put strike minus premium paid equals lower break even. Now let's look at an example on the graph. So for this example, we'll be using the same strike and expiry as the last example, January 21st, 2022 at the 250 strike. But this time, instead of selling a call and a put, I bought a call and a put. I bought a put at the 250 strike for $11,500. And then I bought a call at the 250 strike for $7,500. So here's what the long straddle would look like on a graph. We see that it's the inverse of the short straddle. The short straddle looked like a triangle, and the long straddle looks like an upside down triangle. Our max gain is unlimited. We can see that as we move to the upside, our gains keep increasing. Same thing for the downside. As we keep moving more to the downside, our gains keep increasing. Our max loss would be when the underlying finishes at the strike price, which is $250. Our max loss would be our net premium paid, which would be $19,000. $11,500 plus $7,500 equals $19,000. We can see here that our lower break even would be when the underlying is at $60. The way we get this is we take our strike, $250, minus our net premium paid, which is $190 or $19,000. And we get 60. We can see here that our upper break even would be when the underlying is at $440. And the way we get that is we take our strike, $250, plus our net premium collected, which is $190 or $19,000. And we get $440. So for this trade to start making money, the underlying would have to go below $60 or above $440. Now let's move on to the short strangle. This is similar to the short straddle, except instead of selling a call and a put at the same strike, you would sell a call and a put at different strikes, but the expiry date is still the same. You will receive a net credit for this trade. This is a neutral strategy. You would receive less premium than the short straddle, but it is less risky. The net premium collected equals max gain. This is achieved when the contracts expire between the short call and the short put. The max loss is unlimited. This occurs when the underlying goes deeper in the money, in either direction. The short call strike plus the net premium collected equals the upper break even. The short put strike minus the net premium collected equals the lower break even. And now let's take a look at an example on the graph. Alright, for this example, again, we're going to be using GME for January 21st, 2022. So I sold a put at the 190 strike for $6,300. And then I sold a call at the 230 strike for $7,300. So here's what the short strangle would look like on a graph. The short straddle looked like a triangle, whereas the short strangle looks more like a trapezoid. We can see here that our max gain would be achieved if the underlying finishes between our strike prices of 190 and 230. Our max gain for this trade would be $13,600 because that was the net premium collected for this trade. $6,300 plus $7,300 equals $13,600. Our max loss is unlimited. We can see that as we move more to the downside, we keep losing more money, and as we move to the upside, we also keep losing more money. Our lower break even would be when the underlying is at $54. The way we get this is we take our short put strike, 190, minus our net premium collected, which is 136 or 13,600, and we get 54. Our upper break even would be when the underlying is at 366. The way we get this is we would take our short call strike, 230, plus our net premium collected, which is 136 or 13,600, and we get 366. Finally, let's go over the long strangle, and this is essentially just the inverse of the short strangle. To set this trade up, you would buy a call and a put with different strikes and the same expiration date. You will receive a net debit for this trade. This is a neutral strategy, and you are looking for big moves in either direction. The max gain is unlimited. Your gains increase as either the long call or the long put finishes deeper in the money. The net premium paid equals max loss. And this occurs when the contracts expire between the long call and the long put. The long call strike plus the net premium paid equals upper break even. The long put strike minus the net premium paid equals lower break even. And now let's take a look at an example on the graph. So for this example, again, we're going to be using GME at the January 21st, 2022 expiry date. I bought a put at the 190 strike for $7,100, and then I bought a call at the 230 strike for $8,200. And here's what the long strangle would look like on a graph. It's the inverse of the short strangle. It looks like an upside down trapezoid. Our max gain is unlimited. We can see that as the underlying moves more to the downside, our gains keep increasing. Same thing for the upside. As the underlying moves more and more to the upside, our gains keep increasing. Our max loss occurs when the underlying finishes between our strikes of 190 and 230. Our max loss would be $15,300 because that is the net premium we paid. 7,100 plus 8,200 equals 15,300. Our lower break even would be when the underlying is at $37. The way we get this is we would take our long put strike, 190, minus our net premium collected, which is 153 or 15,300, and we get 37. Our upper break even would be when the underlying is at 383, and the way we get this is we take our long call strike, 230, plus our net premium collected, 153 or 15,300, and we get 383. And that does it for this episode of How-To Options. We went over straddles and strangles, specifically short straddles, long straddles, short strangles, and long strangles. Hope you guys enjoyed the video. Please hit the like button and please subscribe, and catch me every weekday after market close on the Smarter Gambling Show. Thank you everyone for watching, and I'll see you guys in the next one. Peace out.